Chair Jay Powell expected to announce the next rate hike on Wednesday. Joining us now, Roger Ferguson, former Federal Reserve Vice Chairman and former TIAA President and CEO. He's now Vice Chairman of the Business Council and a CNBC contributor. Roger, I don't probably we're getting ready to come on the show, getting all fixed up and makeup and everything. You may not have heard what I said earlier, but I noted a change in tone on both sides of the argument last week after those hot inflation numbers. I think that the middle has gotten more elusive and probably Jay Powell's job has gotten tougher. We had some people last week talking about a need for at least a full point hike. One individual, he's a money manager, he's not an economist, but he's a smart guy, a global guy, said we need 1% to 2% increases to get this under control. Conversely, we had Barry Sternlicht, real estate guy, obviously, but a billionaire who said we need to stop immediately because we're on the precipice. The U.S. economy and global economy is on the precipice of a really sharp slowdown. Both sides can't be right, Roger, and I feel for Jay Powell. Where are you on this?
I'm in the position that says the Fed needs to continue to execute the strategy they've laid out. I think 75 basis points is the more prudent move this time. And I think they have to signal in their, what's called their SEP, the Summary of Economic Projections, and also, very importantly, what Jay Powell has to say in the press conference, that they're going to stay on that path. They cannot be dissuaded. And that is because I think inflation is the clear and present danger here. And I think they have to be prepared, and we have to be prepared for what Chair Powell called, which is some pain, i.e. hopefully a short and shallow recession. But getting inflation under control is job one, and moving methodically up this time, 75 basis points and indicating more to come, I think is a better approach.
The hot numbers we saw, Roger, they were hotter by tenths of a percentage point as far as expectations. So I guess my question is, if you really believe that the supply chain issues that occurred after the reopening from the pandemic, if that's primarily what's to blame here, you could still say those might be transitory, that once things loosen up. So I'm wondering whether you think that or whether you really do believe what some other people feel, and that is that we've just lived way beyond our means in terms of fiscal spending and monetary spending, and that this is deeply ingrained and it's going to take more than a few 75 basis point hikes to get it under control. What do you think?
I think three things. One is this inflation has many causes. One of them that you didn't mention, but is primary in my mind, is very tight labor markets. As I talked to CEOs, and I talked to one just last weekend, he was discussing the fact that it's the labor market tightness that's really driving, pricing concerns and inflationary pressures. So we have to recognize that. Secondly, obviously, geopolitical concerns. We've been relieved that oil prices have come off, quite a bit, but there's nothing that will stop them from rising again, and so there's still some uncertainty there. Supply chains, yes, loosened up somewhat, but we've seen China closing and opening, on and off depending on the pandemic and COVID in that country. And so I'd say the inflationary pressures have many causes, and they really aren't clearly and consistently abating. Labor markets in particular are still very tight. We have had, to your second point, a period of very loose monetary policy, and for a variety of reasons, fiscal stimulus as well. Time to rein that in, and I think some people thought the Fed was maybe a little slow in starting that process.